Walmart's stock is soaring, defying intrinsic estimates suggesting 55 to 75% overvaluation. Profitability is shrinking, and a bold digital pricing overhaul faces intense backlash. Is the market simply wrong, or is a hidden trap about to wipe out investor gains? This isn't just about Walmart, it's mastering fundamental analysis in today's complex stock market. When we examine this valuation paradox, the market often operates differently. Investors bid up Walmart's stock, pushing metrics like the price-to-earnings ratio, comparing stock price to revenue, significantly higher. Mainstream narrative champions resilience, but intrinsic models suggest substantial overvaluation. This disconnect frustrates many. The golden rule for value investing? Market sentiment, while powerful short-term, rarely dictates true long-term value. Ignoring fundamental analysis is a classic trap, leading to portfolio stagnation. You'll view market narratives anew. Now, let's explore the profitability puzzle. Walmart reports a healthy 5.6% revenue increase. Does this signal a thriving business? Look closer. Top-line growth masks significant core profitability erosion. Both EBITDA, a measure of operational performance, and net income have declined. Net margin, which is revenue after expenses, shrunk from 2.9% to a mere 2.2%. This signals robust sales but rising operational costs, a 12.2% increase, relentlessly squeezing profit. Relying solely on revenue growth is dangerous. True financial health means sustainable profit. The investor's lesson here? Scrutinize earnings quality. Do not let top-line numbers distract from bottom-line realities. They explain why returns are not matching the market buzz. To grasp these pressures, consider Walmart's digital pricing revolution. They are aggressively rolling out digital price labels, promising substantial operational efficiencies. This is crucial modernization. But here is the twist. Fierce public and regulatory backlash. Concerns about dynamic pricing, meaning unpredictable real-time changes, led to policy shifts, with proposed legislation now on the table. This delicate balance navigates public distrust. The investor's lesson: even sound initiatives carry significant non-financial risks, especially those touching consumer trust and sparking regulatory shadows. Your investing strategy must anticipate these reactions. Speaking of cost structures, we see an operating margin anomaly. The recent quarter saw an improved operating margin, profit on sales after variable costs, reflecting better core retail efficiency. That sounds positive, right? Yet, net margin declined significantly. This indicates expenses beyond direct operational costs are rapidly increasing. Day-to-day management tightens, but other factors like higher interest expenses with Federal Reserve rates at 3.50% to 3.75%, or other non-operating costs are pressuring final profit. Many casual investors miss this crucial point. The investor's lesson: operational efficiency alone is not enough. Always examine the full picture of expenses, both operating and non-operating, for true profitability. This is crucial for sound fundamental analysis. How does a company navigate complex costs? Let us look at liquidity's tightrope walk. Walmart boasts improved net operating cash flows and free cash flow, cash left after expenses and capital expenditures, boosting its net cash position. This often signals financial strength. However, here is the paradox: persistently low short-term liquidity ratios. Its quick ratio, a measure of its ability to meet short-term obligations with liquid assets, and its current ratio remain below healthy thresholds. Even net working capital is negative. This signals difficulty covering immediate liabilities. Many investors fixate solely on cash flow, but the investor's lesson: strong cash flow must be assessed alongside short-term solvency. A company can generate cash, but with a lean asset base, it is walking a tightrope. Unexpected economic slowdowns, even with gross domestic product growth at 2.1%, could expose vulnerabilities. You can check this for yourself. The market bets heavily on the future, fueling an investor-driven premium. Walmart's high PE ratio suggests strong investor confidence and elevated future earnings expectations. The mainstream view: Walmart is a stable, long-term play despite 2.4% inflation. Yet, a recent quarterly decline in earnings per share, or EPS, challenges this narrative. It signals increased operational costs, lower revenue growth, or short-term market pressures. Investors prioritize long-term expansion over immediate fluctuations, making future earnings critical. This is a classic example of growth expectations outweighing current performance, a trend that can reverse if those expectations are unmet. The investor's lesson: understand the difference between speculation on future growth and investment in current verifiable value. Unwarranted premiums often disappoint your investing strategy. Future bets tie to asset efficiency versus capital intensity. Walmart aggressively expands its asset base, a 9.1% increase in total assets and 30.8% growth in property and equipment. Positively, the assets turnover ratio, which shows how efficiently assets generate sales, is increasing, indicating effective utilization. The market might see this as positive for retail sales, growing around 3.2%. However, a slight quarterly decline in return on assets, or ROA, which measures how well profit is generated from those assets, suggests increasing assets might outpace profitability. This highlights the high cost of growth. The investor's lesson: growth is not inherently good. It must be profitable growth. Question: if massive capital investments truly deliver commensurate returns, or if they just consume more resources. Underpinning these dynamics is the regulatory shadow. The digital price label rollout thrusts Walmart into a contentious regulatory spotlight. Concerns about dynamic pricing spurred policy shifts. Critics warn of potential misuse. This introduces uncertainty, potentially limiting innovation or increasing compliance costs. Common investors see this as external, but seasoned investors understand policy shifts are fundamental. The investor's lesson: ignore the regulatory environment at your peril. It quickly shifts the competitive landscape, impacting strategy execution, flexibility, and brand reputation. Every serious stock market analysis should consider this. Despite these headwinds, Walmart possesses a hidden strength. Beneath fluctuating profitability, it boasts formidable financial bedrock. A strong Piotrowski F-score of 7 out of 9, which indicates overall financial strength, and an Altman Z-score of 7.94, which predicts bankruptcy risk. Both affirm robust health. Strategic long-term debt reduction has strengthened its balance sheet, reflected in healthy debt-to-equity and debt-to-assets ratios. These ratios assess debt usage, remaining well within low-risk zones. This resilience absorbs operational pressures and funds new initiatives. This is the crucial counter-narrative to short-term profitability concerns. The investor's lesson: never overlook balance sheet strength. It is the ultimate safety net, the true indicator of a company's ability to weather storms and fund its future, no matter market volatility. This simple rule is incredibly powerful for any value investing approach. So, is the market entirely wrong about Walmart? Not entirely, but it is overlooking critical fault lines. The current premium valuation is driven by an optimistic future narrative, not a clear-eyed assessment of profitability erosion and intrinsic value. The truth: Walmart is fundamentally strong, with immense financial resilience and strategic vision. However, this strength is tested by persistent profit erosion and significant regulatory and public trust challenges. That is why I believe within the next 18 months, market enthusiasm will reconcile with profitability realities and high digital transformation costs, leading to a significant recalibration of Walmart's valuation multiples. This crucial insight empowers you to make smarter decisions in your investing strategy. But I want to hear your take. Does Walmart's strong balance sheet truly offset its shrinking profitability and regulatory challenges, or is a major valuation correction inevitable? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.